Chapter 11, Risks and Rates of Return. Learning Objectives. Compute the risk and return of an investment and explain how the risk and return of an investment are related. Identify relevant and irrelevant risk and explain how a relevant risk can be reduced. Describe how to determine the appropriate reward, that is, risk premium, that investors should earn for purchasing a risky investment. Describe actions that investors take when the return they require to purchase an investment is different from the return they expect the investment to produce. Identify different types of risk and classify each as relevant or irrelevant with respect to determine an investment's required rate of return. Defining and measuring risk. Risk is the chance that an outcome other than the one expected will occur, is the variability of returns. Expected rate of return is the rate of a return expected to be realized from an investment over a long period of time. It's the weighted average of the outcomes where the weights are the probability. Measuring risk. Coefficient of variation is calculated as the standard deviation divided by the expected rate of return. Portfolio risk and a capital asset pricing model. Portfolio is a collection of investment securities. CAPM is a model based on the proposition that any stock's required rate of return is equal to the risk-free rate of return plus a risk premium, where risk reflects diversification. The required rate of return for a stock can be illustrated in security market line. The line that shows the relationship between risk as measured by beta and the required rate of return for individual securities. Key risks and rates of return concepts. What does it mean to take a risk when investing? The chance of receiving a return other than the one expected. How are the risk and the return of an investment related? Riskier investments must offer higher expected returns than less risky investments. Otherwise, people will not purchase investments with higher risks. What are relevant and irrelevant risk? Relevant risk is non-diversifiable risk because it cannot be eliminated, even in a perfectly diversified portfolio. Irrelevant risk can be reduced through diversification. How is appropriate reward or risk premium determined? The effects of non-diversifiable risk can be determined by computing the beta coefficient of an investment. An investment required rate of return can be computed as What are different types of relevant and irrelevant risk? Relevant risks include those types that are related to economic factors such as interest rate risk, inflation risk, and so forth. Risks that are not relevant because it can be diversified away include those types that are related to a specific firm or industry, such as business risk, default risk, and so forth.